Well, the Santa Claus rally was a complete failure, and that ruins the first component of the January trifecta. So instead of another year with double-digit returns, perhaps we just get single-digit returns in 2025. But even more urgent than that is keeping a very close eye on the December low, because if the December low gets taken out, there's about a 50-50 shot that 2025 actually closes red. Oh, and of course, the December low also marks the daily head and shoulders neckline that everybody is watching. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY monthly time frame chart now that the December bars have officially closed out. What do we see in terms of candle structure and location? The candle in question is the second one in. Of course, it's a solid-bodied red bar with very minimal upper wick and very minimal lower wick. The defining characteristic is the very weak close towards the lower third of the monthly range, which of course is a bearish data point. If we're thinking about location on the bar-to-bar count, we do see a higher high, which is also a brand new all-time high, along with a higher low and a close just in the midpoint of the previous month's range. We did not close underneath the previous month's low, which to me is much more of a bullish data point. So we're mixed on the bar-to-bar count, which means that we should really just rely on the overall trend of the monthly time frame, which of course is in the upward direction. This all began with the monthly inverted head and shoulders down here. We broke out and we offered a higher low above the retest of the neckline. This was the next monthly higher low, and this is a soft monthly higher low from the August 5th panic. This, of course, was a high, and we're pulling back from the highest high in the monthly trend count. So the question becomes, is it reasonable that the monthly trend could afford to produce a higher low? And if so, where is that level? Well, the first answer is yes. Of course, we can afford to produce a monthly higher low. And the second answer is, in my opinion, somewhere here, around 530. Now, please, this is not a forecast for the early stages of 2025. Everybody seems to want to say, oh my goodness, the market's overvalued, it's got to crash. This is just a reference to what would keep the monthly trend in the upward direction, right? There's the opportunity for a monthly higher low here after pulling back from the highest high in the trend count. Now, of course, we will acknowledge that there will absolutely be bearish trades to take, big time shorts on the intraday and intra-week move if this does ultimately take place. But the illustration is that there's a higher low opportunity on the monthly. And everybody's talking about this as if it has to happen. Oh my goodness, the market can't possibly move in the upward direction any further. Valuations are stretched. Valuations are a horrible timing metric. What's not a horrible timing metric is using the monthly trend to your advantage. We all know, and we've talked about this in previous episodes, that when the monthly trend flips to down, that's when there's a good reason to panic, right? Monthly trend is down, we get a protracted down move through 2022. We can go back to the great financial crisis. As we scroll back over here, you have highs, equal highs, lower high, notice the lower low, and we've gone through this exercise in the past, right? The monthly trend is down. Here's the big painful moment that everybody remembers, right? Same thing is true through the dot-com bubble bursting. You have highs, equal highs, finally a lower high. From here to here, you had lower lows. You're in a monthly downtrend. Painful moment number one, painful moment number two. So the point of the exercise on the monthly time frame chart here is to really just emphasize that the trend is far stronger than most of the other time frames where there's been a protracted down move in the market. I'm not saying it can't develop to become one of those. And of course, this is a reasonable threat that we should probably be concerned with if something like this were to happen, right? If you had a monthly lower high emerge over time, but at that point, we're talking about almost a full year's worth of trade. So that's not really on my docket for the first quarter of 2024, right? And again, the illustration is that the monthly trend remains pretty strong and we're pulling back from the highest high in the trend count. A couple of Fibonacci's I want to share with you from the 2022 low up to the all-time high. The 530 level I was just referencing here, you call it 525, you're splitting hairs. It's really previous resistance has the opportunity to act as new support, right? It's over the Fibonacci 38.2. It's over the previous all-time high. So all set from that perspective here. There's another Fibonacci perspective I want to share with you, which might actually side a little bit more so with stagnation, consolidation, or even heck, a pullback, right? If we use the measured move from here, we actually hit that in December, right? We had talked about this measured move for a long while. It was around 610. There was a lot of confluence at that area. That's where we're pulling back from. So is this a logical place where the market might slow down on the monthly time frame? Sure, absolutely. No problems from that perspective. I also want to talk about the stat we mentioned in the intro. Of course, last year, if you take the opening print of the January bar to the closing print of the December bar, the return was 24.13%. Depending on who you ask, it might be just shy of 24%, just above 24%. Undoubtedly, a very, very strong return. The statistic we talked about in the introduction, if we're expecting a single-digit year of returns, would bring the S&P from the January open to roughly 648.70, 647.75, I believe, is it 25.75? 648.25 would be a 9.99% single-digit return for 2025, just as a reference point. And once again, this is not a hard and fast forecast, but we're just giving you an idea of what could potentially take place through the calendar year. And heck, if you were to get a move that pulled back into this low and then went on to rally towards that high, if you're long from the pullback low off of 530, 525, that is a very impressive move here on the monthly time frame chart, just to spin it a little bit more optimistically headed into the new year. Let's drop this down to a weekly time frame chart. Let's go back to a clean chart here, and we'll start to get into the more granular analysis. What do we see here in terms of candle structure and location? Of course, structurally, it's the exact opposite bar of the previous week. And keep in mind, both of these are shortened holiday trading weeks. So it's a green-bodied hammer candle where, of course, we know that the buyers stepped up towards the lows of the weekly range. They pushed prices not only back up to the opening print, but through the opening print for range expansion. They were able to close towards the highs of the weekly range. That is absolutely bullish on the weekly structure. If we're thinking about location bar to bar, it's the opposite of the monthly, right? With a lower high as well as a lower low. So we're split on the bar to bar count, one bullish, one bearish. The overall trend here remains in the upward direction, I would argue, and we're still trying to navigate the key higher low right here. We've talked about for weeks now that 585 acted as soft higher low support, firm higher low support, or at least it's attempting to, on the Jerome Powell plunge. And last week, the weekly structure, the hammer candle supporting off of that same exact level, probably sides once again with the bulls on the higher time frame weekly chart. So if we could take out last week's high and see a move in the upward direction, the name of the game here is really trying to navigate back up towards the equal high, which is the all-time high. So the weekly chart's bullish, the monthly chart is bullish. We have the higher low pullback potentially brewing here on the weekly chart. The monthly can afford a higher low. We're good to go from that perspective. If we continue to check in on the Fibonacci's from the bottom here up to the top, this is still all taking place over the Fibonacci 38.2. From this pullback low up to the all-time high, we are still respecting the 61.8, but we did happen to close back down underneath the 38.2. If we check in with our anchored VWAPs on the weekly time frame chart, I've added one to the all-time high back from over here. We are technically underneath 2 of the anchored VWAPs, but we're above 3. So we're sort of in the anchored VWAP cluster. I would say things get much more encouraging for a new all-time high if we can start to trade up and over roughly that 595 level. We'll see that on the daily chart in just a moment. Let's be very comprehensive here and continue to take a look at the indications such as the volume profile on the weekly. Let's go down to a 6-month chart. That'll be just fine. And we just want to continue to reflect on the idea that we're supporting over this high volume node. 1, 2, 3, 4 interactions off of the high volume node. Buyers continue to step up here. As long as we're above this level, we don't definitively have complete overhead supply yet. If we were to break back down underneath, we all know that the target is the equal low on the SPY weekly time frame chart at 570. That would neutralize the weekly trend. We're not there yet with the green bullish hammer candle happening at support and not breaking down underneath a clustered component of the anchored VWAPs, the big time Fibonacci 38.2 from the August 5th panic low back here, nor the high volume node that we've just explored. So let's drop it on down to a daily time frame chart. Let's get even more granular. And of course, the first thing we evaluate over here is the weekly expected move. So this gray shaded area, if you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at $600.39, implying, yes, a high over the previous week's high, but still a lower high underneath the bottom end of this overhead supply at 603 flat. That's really not all that encouraging. If we take a look at the lower bound, it is at 583.53, and that would imply a higher low over this double bottom low and the remainder of the election gap, but at this point, I'd really just start to lean into this as equal lows on the daily time frame. The trend here is in the process of changing. The trend is not so clean, right? We know that it's very possible that from here to here, we have a lower high, but from here to here, we just have equal lows. The daily trend will be definitively down when and if we breach for a larger lower low underneath this area right here. The key level is at 580.75. The picture-perfect continuation of this big V-shaped recovery would have been for the higher low to look something like this, and then try to flip the daily trend back to up with a move into the equal high. Obviously, that has not taken place, and we are getting consolidation, I would argue, underneath the key line in the sand that we talked about last week. However, we did see a Friday close over that level. 590.75 does not change. If we are over that level, I would be a little bit more neutral. If we are under that level, it is absolutely bearish consolidation for the infamous, at this point we'll dub it, head and shoulders that everybody is paying attention to. The consolidation here is absolutely bearish, and we will look for the remainder of the election gap to close if we start seeing more price acceptance underneath the two-day lows from Monday and Tuesday at 584.75. This is game on for shorts, looking for the gap to close. It's at 576.75. If we start to see neutral acceptance tangled up near the 50 SMA, it's just going to be very simple to watch 590.75 and 595.25. If the market does make a stand over 595.25 and sets a higher low here, I would, very promptly get back on the bull side of the market looking for a move in the upward direction. Why would that be the case? Well, because we know that the weekly trend is in the process of trying to hold a higher low. The monthly chart is absolutely in a very strong uptrend, just hardly pulling back from the highest high, the all-time high. And if we can hold on to the December low is right here, right? If we don't break down below that, it really sets up the opportunity for a more bullish first quarter of 2025. So the key levels on the daily time frame chart, if I had to just give you two, it's all about 595.25 and 590.75. If we're in here, it's no man's land. We have to wait for a reaction on either side of the two guardrails. Up here, it's absolutely more bullish, looking for upside. Down here, the bear flag consolidation persists, the head and shoulder persists, and we actively start looking for short opportunities underneath 584.75 to close the gap from the election down at 576.75. Preference as of right now is really taking it day by day. Unfortunately, it's another shortened holiday week. Markets will be closed on Thursday in observance of Jimmy Carter's funeral, I believe. So consolidation in here day by day, not really all that impressed. Up here, we get something going on. Down here, the bears maintain a little bit of an edge that they've been building on the daily time frame, right? Let's come in here on the hourly time frame chart. We'll get a little bit more granular. A couple of things I want to point out is just the big failure from the Thursday session, really. The first trading session of 2025. We opened in range, and the buyers really had the opportunity on the opening drive to the upside to set a move over 590.75, produce some sort of higher low from here to here. Didn't happen. But on the flip side of the coin, we had the two-day balance range from Monday, Tuesday, right? Look at what happened into the close of Thursday. You closed underneath 584.75. So in theory, what should have happened if we had stronger sellers participating in this market? They should have yielded bear flag consolidation underneath and gone on to close the election gap as soon as Friday, or possibly set something up for early this upcoming week. And instead of that happening, you can clearly see that on Friday we opened inside of the two-day balance range from here. But it gets better than that, right? And this is why I maintain a little bit more of that bullish stance here coming into the new week. It's really because instead of rallying and rejecting the 590.75, staying in range, keeping lower highs on the table, what happened? You can see from here to here, we actually set a higher high. And this is really what, sort of develops the daily close above the level, obviously, but more importantly, the weekly hammer candle, right? The weekly hammer is a product of Friday's rally. So as long as we can stay over this 590.75, I might even say on the more nuanced hourly take, sure, the daily might be neutral in here, but the hourly is in the process of producing look below and fail, move to the top end of the range, and now if we can stay over the range, it's game on for upside. So risk reward early in the week might look something along these lines. If you could balloon runners beyond that for something that does this, I mean, great. Now your risk reward does the same thing in the upward direction. And now we have an equal high. In which case, what does the daily trend do? The daily trend neutralizes, right? So really, the levels are very clear here is what I'm getting at. And as of Friday's move, it seems to me that the buyers have capital T, capital G, trademarked, registered, copywritten, the gift. Buyers have the gift so long as they can hold price over 590.75. So to give you some actionable takeaways, an open above on Monday, great. Holds and rallies is the name of the game. Rallies, maybe a pullback first, and then a Brigade bolt over 595.25, bulls on parade. If we fall back down underneath 590.75, this is where I would look for a short actively on the lower high here for a range rotation back down to the bottom side. Why? Because it's the exact opposite of what happened over Thursday, Friday. This was look below and fail, targets the top end of the range. This could easily turn into look above and fail with a lower high here to target the bottom end of the range. We know that we're actively looking for shorts as well on lower highs underneath 584.75 for the remainder of the election gap to close at 576.75. A couple of additional indications, then we'll get into some supporting evidence. From the Jerome Powell plunge to the lows, we all know that the 38.2 is right here. The fact that we closed above on Friday does stack up as a slightly more bullish than bearish data point. It is in no man's land between the 61.8 and the 38.2. But once again, if you're a stronger seller, especially on the heels of Thursday's breakdown, is this what you want to see? Absolutely not. Sellers probably have stops that are stacked over these highs, right? So if that stop run takes place, it might be the fuel to the fire for something along these lines in the upward direction. If we come in here with the anchored VWAPs intraday, we'll also see that we've recaptured a majority of the anchored VWAPs. Yes, the all-time high anchored VWAP is still resistant here at 595.25, but again, after Thursday's breakdown, more aggressively away from the cluster, underneath the 2-day low, look at how Friday opens here, underneath the cluster of VWAP still, could have produced a rejection here, could have produced a rejection here off the top end of the range. There was beautiful confluence out of the Powell plunge, as well as the gap down anchored VWAP. None of that happened. We closed above, right? So in my view, the buyers have the short-term gift headed into the early stages of this upcoming trading week. Let's take a look at the market profile. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. What do we see here? On Friday in particular, when we got that really impressive rally back to the top end, if not through the top end of the range, we did have decent volume inflows, but they were not up and over 300 million. You'll see a big discrepancy, really, when we jump on over to the NASDAQ in a moment. What was the breadth ratio like intraday as that rally was taking place? It was up around 2-to-1, sustained through the Friday session. Not the worst reads we've ever seen, but stronger, absolutely. Would be up towards like 5-to-1, for example. If we look at the advanced decline line holding the zero line over zero, even as we were getting that plunge on Thursday, the advanced decline line stayed pretty positive over the zero mark there. The index score positive on Friday. Of course, on Thursday, it would be negative. It's always going to reflect more appropriately what's happening intraday, so not a shocker there. If we look at the cumulative ticks, though, this is really where I think we start to lean into that bull edge even more. On Thursday, as the market's falling apart, the cumulative build closes positive, as it does on Friday with that rally. So the question just becomes, as we're getting this bearish consolidation for the 2 days, Monday, Tuesday, prior to the Thursday breakdown, did we really have aggressive sellers hitting the tape? I certainly am not seeing it, right? We don't have any aggressive sellers breaching negative 300 million. We're in trend lower zone to start Monday, but we get out of it. Tuesday's above the zero line. Tuesday's tick is hardly negative. Remember, we're looking for plus or minus 5,000 to be substantial there. It's not really indicative of new money sellers here. And I get it. It's a shortened holiday trading week, but going with the information in hand, to me, it does seem as though the bulls have an edge headed into the upcoming week. As we take a look at the market profile, if you're not familiar with this screen or this type of chart, check out the video tutorial in the top right-hand corner. What do we see here? Certainly, on the Thursday session, value was lower, point of control was lower. So Friday's rally becomes important in the sense that value was able to move outside of Thursday's value, and the point of control was above the value area as well. Now, it wasn't quite enough to close outside of or above the Thursday range, but it's certainly a good step in the upward direction. So early in this upcoming week, the main component of market profile that we'll be watching for is what happens with developing value. Does developing value get up and over this level around, let's just call it 59.95? We know that 6,000 has been the key mark, but does value get over 59.95? And if so, that would probably indicate that longs are either positioned well down here or shorts are what? shorts are getting squeezed, and we'll expect that move in the upward direction. Let's jump back on over to the platform here and take a look through the NASDAQ. Let's take a look at the NASDAQ monthly time frame chart. Jumping it on up over here. Let's go to, are we on the monthly here? Yes, we are. 5 years is just fine. That'll do. All right. The main point of the monthly time frame chart here is just that we have a very similar, oops, we're on the S&P. Like, of course it's similar. We have a very nasty looking, there we go. This is the one that everybody's ranting and raving about, a gravestone doji on the QQQ monthly time frame chart. Has this ever worked in the past? That's the big question, right? Let's go ahead and take a look. What did this do over here? Definitely did not produce a big down move. This produced some continuation, the inverted hammer. This was a month early, but found some continuation. But let's not stop there. Look at these two back here. Was there any continuation to the downside out of those? The answer is no. How about this one? That was an inside bar inverted hammer back in 2020. Did that produce continuation? No. And you could go back and you could look at a bunch of historical examples of this. Let's go out to a 20-year chart. Thanks for bearing with me as I flip through them, by the way. This is the sickness drawdown over here, so a little bit of a black swan there. But what else? Did this produce a top? The answer is no. It was way too premature. If we go back even further, any other big topping tail gravestone dojis here? This, of course, but the monthly trend was what? Already down at that point. And we just went through this whole spiel on the S&P 500, right? Look at this one. Premature to the big drawdown through the great financial crisis. And let's see if we can get max available data. Why not? Just so we can check out the .com era here. Yes, of course, it does look like we marked that with an inverted hammer. So you've got a hit and miss sort of response from this data. This sort of caused a little bit of a pullback here. This one caused a little bit of a pullback here. So hit and miss with the gravestone doji at a 12-month high. Regardless, what is the monthly trend? Are we in jeopardy of changing the monthly trend to down? The answer is no, right? I mean, we could certainly see a pullback here, and I would argue that you probably want to see monthly higher lows hold here out of the NASDAQ. Previous resistance through this zone wants to act as newfound support, much closer to about 485. So you don't have as much wiggle room, if you will, compared to the S&P 500, but certainly could produce a higher low to continue the monthly trend in the upward direction. If we were to take out the Fibonacci's from the bottom of 2022 up to the all-time high, all of this is over the 38.2. This is well above the Fibonacci 38.2. Not an issue from that perspective. What about this monthly higher low to up here? Yeah, still above this Fibonacci 38.2 as well if we use that 485. So all set from that perspective here. Any other indications that we care about? I'm just sort of going on the fly here on the monthlies. Take a look at this. This was not really a bull flag, so I'd be hard-pressed. We talked about this hitting 500 well before. So, you know, this retracement was too deep. Remember that too, right? So if we just come in from the sickness low up to the high, remember we went all the way to the 68.1 instead of holding the 38.2, so it wouldn't really classify as a beautiful picture-perfect bull flag on the monthly. Regardless, all set, monthly trend remains in the upward direction. Yes, we have a concerning December bar, but if we pull back, we know that there's an opportunity for a monthly higher low to keep the trend in the upward direction. Weekly time frame chart. What else can we learn about the QQQ here? Very similar to the S&P 500 with the candle structure. It's a hammer candle that is technically trying to find support over the prior all-time high. And this is the level that I care most about in the QQQ. You've been hearing me talk about this in the morning sessions. You've been hearing me talk about this over on X. We've been posting about 503 quite a bit. I'm very, very skeptical. I would not be an aggressive bear, basically, in the NASDAQ if we're still over this previous pivot high. There's just too much of an opportunity for previous resistance to act as newfound support, which is already taking place. So it has not really paid well to be an aggressive short towards these lows as we're barreling into potential support, and I would maintain that stance here on the QQQ weekly. If we come in from the low of this bar up to the all-time high, notice that this lower wick held the 61.8 Fibonacci to the T. If we come in from the bottom of this, up to this is all taking place over the Fibonacci 38.2. How about our good old friends, the anchored view apps on the weekly? We are above the majority of the cluster. We do have the all-time high anchored view app right here. If we break that, we're back off to the races, expecting that equal high, which is basically the all-time high. So really not a bear here on the QQQ higher time frames either. I think the S&P and the NASDAQ are both poised to potentially set higher time frame, higher lows. And one of the conversation points that we've been having over at Walks in Wall Street with Tom, the channel is Walks and Wall Street. You should check it out. But is just that 2008 and even the dot-com bubble bursting really sort of scarred a lot of people, expecting that every single pullback needs to be this Armageddon-style crash. Oh my goodness, the market's going to shave off 80% of its value and go down to $100 in the QQQ. Like those style interpretations, those forecasts are just totally leaning into the fear of 2008 and the dot-com bubble. As of right now, we're just not even close to structurally that happening, but also, if we think about the underpinnings of both of those markets, not even close from a fundamental perspective either. So anyways, QQQ daily time frame chart, weekly expected move is right here in the gray box. We have 528.40 and down here 508.69. Equal lows across the board and almost an equal high, technically a lower high on the daily time frame chart. The most unfortunate thing for the QQQ, in my opinion, is that on the daily time frame chart, this area in here is quite sloppy. It's been very, very difficult to try to trade this, specifically on Monday, Tuesday's morning in here. It's been very difficult to try to make something of the NASDAQ inside of this box range from over here. This was Thursday's high after the Powell plunge, Friday's high. You had the Monday session before the holiday in here, which was just sort of sloppy around there. You had the low here on the Friday session after Christmas, right? So very, very interesting levels in there, and you can actually see them. Let's just go to the hourly chart now. We're all set here on the daily. We're holding the daily 50 SMA, right? That's a bullish indication, obviously. You have a little bit of a look below and fail on the December low out of the NASDAQ. You've closed back inside of this range that we've been tracking, which is, confluence with this prior high from back here at 514.85. But let's go to the hourly, right? So you can see that the market's done a good job of respecting these levels. If you just sort of map them out a little bit more precisely, you can see that we're getting reactions where we should be getting reactions, even here on that Thursday session. But it's just like, what's the trend, right? If you just sit back and ask yourself the question in this box, what's the trend in that box? I mean, I'm not seeing any notable trend in that box. You had a little bit of up, higher low happening here. You had a lower high happening here. Tried to move up, but then a lower high here. Is this going to set a higher low here and move high? Like very, very lackluster in terms of trend, sustained trend inside of this box. Now, of course, we have to come up with some sort of idea, some sort of expectation of what the NASDAQ can do into the upcoming week's worth of trade, which is where I would lean into some of the data points that we talked about on the higher time frames, right? We're trying to navigate this bullish higher low on the weekly, a bullish higher low on the monthly. I mean, yes, the gravestone doji looks very menacing, but until proven otherwise, it's not the end of the world. I would tend to think that if we can set a higher low over 514.85, it builds out a little bit of a short-term hourly inverted head and shoulders pattern, in which case you would typically target, on a breach of the neckline in here or after the higher low here, the top end of the range here, which would be at 524.75. So risk reward in the upward direction, or on a breach of the neckline, maybe it's something along these lines. We consolidate here, get a Brigade bolt right up to that. Maybe it would be like risk reward. It's not quite as good as if you could catch it off of the 514.85 level, but nonetheless, those are the ideas. Now, do we want to overstay our welcome on this trade? Is this a trade where we're going to go max size, use huge amounts of leverage? No, because what we just talked about was the fact that this is really just a choppy range. It's a little higher, it's a little lower. It's trying to go a little higher. We don't really have a clean trend in this box. So although, yes, on the hourly chart, we might be able to build bullish theses off of this 514.85, just be mindful that, you're dealing with a sloppy range to travel back through in the upward direction. Let's go ahead and take out the Fibonacci's from the Powell plunge to the new low that was made here on Thursday. 38.2 has been recaptured, and I would just argue that this remains bullish for the inverted head and shoulders that we were just talking about. 61.8 is on the money with 524.75, so great confluence from that area. And if we come in here with, of course, the intraday anchored view apps, we can also learn that we're tangled up at the midpoint. So what's a classic saying? Don't exchange in the range, don't enter in the center, and do not diddle in the middle. You're tangled at the anchored view apps. Do you have risk reward here being a button smacker right off the open on Monday if it's right here? Probably not, right? You really need to wait patiently for a test here to set the higher low. Then you're looking for that risk reward, or once again, consolidation sets it in the upward direction. A little bit less in terms of an R multiple, but nonetheless, that would be the trade for higher. I will lean into the same indications as to what we described over on the S&P hourly time frame chart, which is just that Thursday, sellers had the opportunity to set a lower high underneath the daily 50 SMA, underneath the low from the move over here, and it just didn't happen, right? You obviously got an open that was higher on Friday. Technically speaking, it was not so high that it recaptured on the open 514.85. So if we had stronger sellers, even here could have persisted as a lower high. The question just becomes, did that take place? Obviously, with hindsight, the answer is absolutely not. So leaning a little bit, just a little bit, into the long-sided theses on both the NASDAQ and the S&P for these reasons. We're not ignoring the fact that we do have this lower high that's brewing on the daily time frame chart, but it has not paid whatsoever to be an aggressive short near the lows of these moves, right? Really, buyers have been rewarded for that higher time frame view of the weekly setting a higher low and the daily still being above the previous all-time high down here at 503.25. Let's take a look at the NASDAQ market internals, because I did mention that there was a divergence happening over here, and it's just the massive volume inflows on Friday. Look at this. Look at that, would you? Right? You guys know that meme? Anyways, huge move, over 400 million on the Friday session, in trend higher zone on the advanced decline line. Pretty strong cumulative build down over here. If we look at some of the breakdown that was happening on Thursday, just like the S&P 500, any stronger sellers here, any stronger sellers here, and any stronger sellers here? The answer across the board is absolutely not. Once again, another supporting piece of evidence that probably suggests buyers have the gift early on in the coming week's worth of trade. Let's take a look at the NASDAQ market profile. And it's very similar commentary to the S&P 500. Here's value on Thursday. Here's value on Friday. Breakaway clean to the upside. Point of control did actually migrate outside of Thursday's range in the NASDAQ in particular. We do have a poor high from Friday's session, so a repair of that level would indicate a break to the upside, and we'll just see whether or not markets can accept back up towards the top end of the range we were just describing here on the hourly. That would be 524.75 on the QQQ cash. Let's jump on over to the IWM cash ETF and see what's going on. Monthly time frame chart to start. We'll do the full deal top-down analysis over here because small caps have not been playing nicely whatsoever. We all know that, with the Powell plunge, there was no recovery like we saw in the S&P and the NASDAQ. So solid red-bodied bar on the monthly time frame chart, closing underneath the breakout level from in here. We've been tracking this on the weekly time frame chart as well. The level is 227. Monthly failure now means that a monthly lower high can be set underneath, and that's where we would say, okay, this probably spells trouble. We still have the idea that this balance range down here is our strong base, and if we were to get some sort of monthly high or low, we could still look for that. It'd be an equal low at that point. But a sort of equal low 50 SMA catch up, this level around $200 flat in the IWM small caps is absolutely paramount. You cannot afford to see a move underneath that zone. Otherwise, it spells trouble for the broad market as a whole, right? You can't really have small caps not participating to some degree if the S&P is going to be firing on all cylinders, trying to continue its rotation into brand new all-time highs. So I like the developing January hammer. Obviously, we're only 2 days into the month. The biggest thing that could happen here on the monthly time frame is just a recapture of 227 towards the all-time high, right? If you look at this previous resistance over here, you probably want to get at least up to that level as well. That's much closer to the 230 mark. If you come in with a Fibonacci from the bottom end of the rally up to the top end over here, this is all still over the 38.2, but once again, the more time that passes, the higher that this move ultimately goes. The 38.2 is going to start catching up, and if you start breaking those lows, no longer is it picture-perfect bull flag continuation, or consolidation, I should say, on the monthly time frame. So small caps have some risks here on the higher time frames. It's not quite as clean as what we're seeing on the NASDAQ and the S&P. You're already just trading into multi-month equal lows. If we knock it down to a weekly time frame chart, what else can we learn about small caps here? This is the Powell plunge, of course, and this is just that weak consolidation. We're not really seeing that V-shaped recovery off of the lows. And as a matter of fact, there's a strong argument to be made that we already have seen a weekly lower high in the upper wick of the previous week's bar. This is trying to make a move in the upward direction, but you're not sold, or at least I'm not sold, or I should maybe flip the script and say I'm not bought into. There we go. See what I did there? We're not bought into the idea that this market's just going to be a huge long straight back up to the all-time high, which would be up here. You really have to prove it to me by moving up and over 227 on the weekly chart and even the monthly chart. Like we just saw, there's a lot of work that needs to be done from the buyers. If we come in from the August 5th panic low to the all-time high, we're under the 38.2. This is exactly where that lower the lower high rejection is taking place. It's underneath this breakout level, right? So that's confluence there as well. If we come in here with the anchored view apps on the weekly, these two are barreling down on top of us, and these two are still, we're tangled up around them. I wouldn't really call that clean support as of right now. It's an overshoot for sure, but the technical level, the structural element at 227 is far more important. I'd be more concerned about these coming down, meeting us there for resistance, and then causing a larger downside reaction out of small caps. So the sore spot for the broad market continues to be small caps after Jerome Powell broke his promise and said, hey, instead of 4 rate cuts in 2025, you're only going to get 2. That's if you're lucky. More likely 1. So what do we see here? Obviously a textbook bear flag, just like we have a textbook head and shoulders in the S&P 500. We've got a textbook bear flag down here. You had a little bit of a range that built out, look above and fail on that session back here, the green body bar. you're starting to get up and over that 224.25, but not in a material manner where I would start saying, okay, this is a double bottom, right? Because all failed bear flags really just look like double bottoms in hindsight. So where's the neckline? This is so close to that weekly line in the sand at 227 that I would still use that level. This is a great first step, but where do I actually want to be bullish on small caps? Probably on a move over 227, breaking this as a double bottom neckline. That would get me a little bit more excited for the bull side of the market to come back with better strength. But even on that, you're just looking for a retest of the 50 SMA, the origin of the Powell plunge. Those things are kind of interesting in here. I just realized we skipped the expected move for the week, so I'll give you those numbers right now. I'll just verbally say them in case you're tuning in a car or something like that. We have 229.23 at the top end, and at the bottom end, 219.66. That, of course, represents a higher high on the daily trend count and an equal low on the daily trend count as well. Maybe if you want to split hairs, a higher low, I would just call it in the bear flag consolidation range. It's bearish, right? There's no doubt about that. Obviously, underneath the two equal lows here, if the bear flag consolidation persists, you're really talking about a stronger move in the downward direction. And, just to play devil's advocate here, what would be a bear flag style measured move? You're probably looking at something like 211.57. And here we go. Everybody was probably like, what's the measured move for the S&P? Head and shoulders, right? Well, let's do it together here, which is always it's just going to be a Fibonacci extension, right? You come from the head to the neckline, and it's just 100% extension beyond that. So if you made it to this point in the video, you can drop a comment down below in the comment section and just say, oh my God, I'm scared about 552.38. Give me a comment, something along those lines. I'll know you made it to this point in the video where we talked about the measured move from the head and shoulders, right? Daily 200 SMA is down there, but some sort of panic. Oh my God, 552, right? And then I'll know, okay? So let's get back on over to the IWM. Let's go to the hourly time frame chart here. Let's see what else we can learn. It's been a really lackluster week, not much going on inside of the consolidation range. If anything, it just reminds me that, hey, the broad market in the S&P 500 and the NASDAQ is trying to make a stand in the upward direction. And the small caps aren't doing anything. The one call out that you could potentially make here is just that the Thursday session did not produce a lower low, not even an equal low, like what we saw in the S&P and the NASDAQ. So, from that perspective, is maybe there a little bit of a shorter time frame bullish divergence where this, of course, represents a higher low versus the lower lows we saw in the S&P and that? Maybe. I would really start to lean into opportunities that look like this week. Any consolidation here with Brigade bolts there, that's what I would be looking for, right? This higher low really sets up the rotation into this. And if that takes place, it's just going to reinforce more of that bullish stance that I had in the S&P. Not so much the NASDAQ, but absolutely the S&P, right? We've been talking about how the buyers have a little bit of that gift headed into the upcoming weeks worth of trade. This would just be fuel to the fire if this is going to take place, right? It's still counter trend on the IWM, but it will help the S&P 500 in the upward direction. If you get another sweep and then come back down into range, expect the same exact thing as over here. Target should be the bottom end of the range, which is at 218. What do we see out of the anchored view apps intraday? We're over the cluster here, but this is still that risk at 227, which makes sense. That's all set from that perspective. What else do we have here? Let's come in with a Fibonacci from the Powell plunge to the lows. So we're over the 38.2 by just a hair into Friday's close, which once again, I think that based on the evidence in front of us right now, if markets can open up, and this is the key, right? Everybody always gets this wrong. Oh, Matt, you said it was bullish. Buyers had the edge into the early stages of the week. This is the if statement, right? If markets open over 224.25, at least in IWM, and hold above that level, that is a bullish tailwind for the S&P 500, right? If the markets gap down on Monday morning and open inside the range, all bets are off. It's just neutral consolidation in the chop and slop that we've been describing for the past, 5 minutes here? Probably too long in the IWM. Let's take a look over at the market internals for the Russell. And what do we see over here? Decent volume inflows on Friday, not up and over 125 million, but definitely strong, stronger than the S&P 500 on a relative basis. Not in trend higher zone though here. Okay cumulative build, a little bit more neutral, and we balance it out with the Thursday move to the downside. Not really bearish here, not really in trend lower zone here. I mean, yes, there was a down move on Thursday. It did not make that lower low that we were just describing. So, I still think that based on all the evidence I can see, early in the week, it still seems like the higher time frame charts are trying to set the higher lows, and stronger sellers have not fully stepped up into the market yet. Let's take a look at the Rusty Russell. What's going on here? Why did it not reset? There we go. What's going on with value and point of control? Value is mostly, completely outside of the Thursday session, so a good step in the upward direction there. And the point of control just a hair above the Thursday high. So once again, buyers building that very subtle edge here into the early stages of this upcoming trading week. If and we can hold over that key level, the top end of the balance range that we were just describing. Okay, small caps, mission accomplished. We're not going to look at monthly charts of the S&P sectors, but we will breeze through the dailies. What do we see here out of energy? Nice little counter trend move is starting to develop. The fact that this did not set a lower high underneath 85.25 is compelling to me. It now means that a higher low above has the opportunity to produce a higher low double bottom over the neckline. Great. Maybe it's a look below and fail on the overarching range right here. That would be a bullish tailwind for the S&P 500. It's a lightweight sector. It's not going to make or break if it doesn't pan out. What is going to be make or break, this is probably the most important chart for 2025, is the semiconductor ETF. We are doing absolutely nothing in this long-standing balance range. Price has to see a move up and out of this to close the gap overhead if the S&P 500 and the NASDAQ are going to continue to accelerate in the upward direction. As of right now, Friday's session was pretty compelling. Obviously, NVIDIA has caught a little bit of a bid. Semiconductors are catching a little bit of a bid up and over the 50 SMA as well as the midpoint of the balance in here, but still in the range. It would be best if we could get that Brigade bolt up and over 256 here. I will have to change my tone undoubtedly, and we'll be monitoring this day by day. If the market sweeps and takes out 237, obviously, it's just balance rules in play. Look for a range double that brings you into 221, obviously bearish pressure for the S&P 500 and the NASDAQ itself. So really, really important chart here. Semiconductors, how does it resolve out of the balance range? With this second wind coming into NVIDIA, it would seem to me that this is absolutely a possibility that we should keep a very open mind to in the next couple of trading weeks. Utilities, really lightweight sector, also D for defensive, possibly a lower high underneath this range overhead. If it does something that looks like this, I'm not overly concerned. It's D for defensive, it's lightweight, it's not going to make or break the S&P 500. It's also not suggesting risk off as a rotation, right? Here's real estate, obviously very rate sensitive. Bear flag on the lows, but holding up over this prior pivot high, acted as support here. If it goes for a counter trend rally, it'll be bullish, intra-week pressure for the S&P, but please, let's not forget that this is an opportunity for a lower high here, especially if rates don't really back off in a meaningful way. We'll take a look at the TNX in just a moment. Here's communications, trying to catch a higher low for support at the daily 50 SMA. I would think that this as a double bottom is the most compelling argument. If we get over that 100 mark back to the all-time high, it's bulls on parade for the S&P 500. If this just struggles in here and consolidates, it's not bearish, but it's just not as much fuel to the fire. Any sort of big breakdowns that close the gap, yeah, intra-week absolutely have to be bearish, so being mindful of 97.25 and the daily 50 SMA, the blue moving average on your screen. Under that, yes, it's a headwind for the S&P, and we'll take that into consideration. The technology sector has been a little bit sloppy here. You've got these equal highs straight across the top, which, as we've mentioned in the past, is the improper end of the auction. I would really expect that this level gets taken out if tested again. That's 242. Carrying that forward as a bullish data point. Got a little bit of an overshoot on the daily 50 SMA here, but nothing so severe where I'm like, okay, the trend is changing to down. You've sort of got, maybe this sort of equal lowish thing holding on in here. It's sort of more like the semiconductors ETF, where this could even just be construed as a balance range. We're in the midpoint. It'd be more compelling if the price could, or if price in general, could stay up and over 238 and get consolidation here, in which case, again, I think that repair of the three equal highs is really a compelling argument for higher in the broad market. Where would I be concerned? I've been moving the goalpost a little bit on the XLK, but with the resiliency in the S&P 500, I think that's maybe not fully warranted, but I don't think it's worth sounding the alarm yet. I would start sounding the alarm if we move firmly underneath this gap close down here, 228, 227. If price starts to trade in this territory, that would be a little bit more concerning, right? You're not holding up over the big weekly breakout level. This goes back to August, right? So that would be the concern there. Financials starting to play nicely by stopping the bleeding, if you will, after the Powell plunge. They've continued to go sideways. JP Morgan, as we'll see in just a moment, is trying to produce that look below and fail, which is helping out the XLF. This, to me, is one of the more compelling arguments for the rotation in the market to keep things afloat in the S&P 500. The fact that the financial sector moved into the gap, right? This is the election gap back here, and was, sellers were unable to continue that, right? That was just the dead low of the move. What's going on? Stronger sellers should be like, no, Powell plunge. Oh my goodness, there's no thin, there's thin structure underneath. We should at least make it to 46.75. No dice. No dice on that. So if this turns into a double bottom, it's just bulls back on parade. Ideally, this gets price acceptance back up and over 48.70. We really just had a consolidation range last week. Over 48.70 puts the bullish pressure into the S&P, looking for at least the neckline retest at 49.60. Beyond that, it's just the all-time high. So is there anything bearish to say about financials? Not really, right? Is there the opportunity for a lower high? I mean, maybe, but the lack of gap close here and the fact that we're just consolidating and potentially about to Brigade bolt over that neckline, That to me is the more compelling watch for the S&P 500 as a whole, with tailwinds at our back. If we were already in a long-standing downtrend, of course I'd be bearish, but we're not. Let's move along to industrials. This, unfortunately, is not as clean as the XLF, right? This is about 8% of the S&P 500. Notice the lower high that was set underneath this previous pivot. Obviously, we're well underneath the neckline of this as a double top, so it's kind of game over in terms of the ideal uptrend remaining intact on industrials. If this consolidates, maybe it's a bear flag and we get lower over time. That's absolutely an opportunity now that we are in more of a constructive downtrend. If it's going to squeeze and do something that looks like this, it's intra-week bullish pressure for the S&P, but I would absolutely change my tone on a retest here, looking for a possible lower high. Right, the breakdown has been too severe from top to bottom, where I would have to imagine there's at least an attempt. Daily 50 SMA, structural elements, some lower high attempt at 138.25. It's a medium weight sector for the market, so it's worth keeping tabs on. We're not there yet, but that's an idea, right? We talked about the S&P. Here's the healthcare sector. Really ugly, still just producing bear flag consolidation down here. Thankfully, it's reduced in weight by market cap for the influence over the S&P itself. So not as concerned. It's now the fourth heaviest weight sector by market cap. It is still D for defensive, of course. The fact that it's underneath, we actually need more time to look at this. It's unbelievable how much damage had been done on the RFK appointment and just generally the new administration and everything going on here. Look at this, right? The fact that this is now all overhead supply, you're consolidating underneath, that's like a year and a half, just shy of a year and a half. Sorry, a year. It's a full year, basically. A full year's worth of gain in the XLF evaporated, right? Over the last couple of months, the last quarter of the trading year. Who wants to be long healthcare components at this point with the incoming administration, their feelings, of course, on that. And, aside from that, forget about the administration, forget about politics. Look at the chart. You want to buy this in a downtrend? It would need to show me some sort of daily reversal before I'm even remotely interested, right? It would have to rally, it would have to produce a higher low, and then it would have what? Maybe some sort of inverted head and shoulders. We're just so far away from calling a bottom in the XLV that it has to remain bearish pressure until proven otherwise. So that's noteworthy there. XLB, the lightest weight sector in the S&P 500, it too is giving back a lot of gain from 2024, specifically underneath this level here. But because it's so lightweight, because it's not really a big deal for the market, not as concerned about this chart. We've been mixing this one in recently, the XHB, which is home builders. The fact that home builders are off so aggressively, that is a little bit more of a concern. We know that this absolutely has much more to do with the cyclical side of the economy. We can put on that comparison line, just like we did last week. Should automatically be the SPX. It absolutely is. So this divergence is pretty meaningful. We've only been divergent one other big time, which is this move lower in the XHB versus this pink line moving higher here. That was divergent. It didn't really result in a huge correction in the S&P 500. This is the August 5th panic happening here. So I'd say that's much more related to the Bank of Japan. But generally speaking, it can be divergent, but it typically does not have a history of remaining divergent for very long. Notice how this moves almost in lockstep, right? So anyways, XHB, big bearish divergence. It's something worth paying attention to. It's one data point through the many data points we've looked at so far in today's episode. Is that enough to just get out there and start slinging shorts with both hands? As we said in last week's episode, the answer is no. Let's move along to the XLP consumer staples. What's going on in staples? This is D for defensive, underneath a big time overhead supply. You could call this double top 1-2 under the neckline here. So it's bearish pressure, undoubtedly, but it's a lightweight D for defensive sector. So is there a defensive posture taking place as the S&P is pulling back? No. Absolutely not. Our risk-on sectors still look okay. Let's do discretionary first and then the TLT bonds. Discretionary is pulling back to that daily 50. It's very important that this holds up here. Previous area of resistance acted as support. We would ideally like to see this act as support again for a weekly higher low, right? You want a weekly higher low here after having already set a daily lower high. So there's the, and from here to here, obviously a lower low as well. So you're in a daily downtrend, but the weekly higher low needs to persist off of the 50 SMA and the retest of this level here. So consolidation keeps me neutral, the XLY. If we get a Brigade bolt here, I would be bullish back over 227.50. Under 219.75, we have to call it for what it is. The daily downtrend is continuing. I would expect a continuation possibly for that stronger retest of 203. That would be an issue for the S&P 500. We're not there yet. We are getting a strong response off of that 50 SMA. I would remain optimistic until proven otherwise. And, of course, if this doesn't hold, the weekly higher low is off the table. If the weekly higher low is off the table and the daily trend is down, obviously the writing's on the wall. It's not going to be easy for the S&P 500 to maintain its bullish uptrend. So that's your key level here, 219.75. All right, bonds. Bonds. Bear flag consolidation down towards the lows. You guys know, and I'll continue to keep you transparent on this. I've got a short put position with 85 being the net strike, basically, where I'll get assigned if prices move lower. And I'm going to maintain that. I'm going to maintain that because if you look on the TLT out, and not that it can't go lower than this. Let's go max available. There it is. It's always sneaking down there. Not that bonds can't go lower than the lowest low. Of course they can if yields were to move in the upward direction. But I would love to take a stab at risk reward longs off of 85, 80, someplace down here. So I'm starting to nibble with that short put position. What's the analysis of the daily time frame chart? Yeah, it's a bear flag. It's a bear flag. It would seem to me that rates have the opportunity for some sort of move to continue in the upward direction, right? Obviously, this is inverse to interest rates. A breakdown through these lows sends interest rates higher, possibly to close the gap here out of the TLT. This goes back to, I believe, 2-3 years ago. Let's go back to 3 years. Yes, the October lows in bonds from 2023. There's your gap up. That's the unclosed gap. So the 85 strike is the gap closed, basically. That's one of the reasons why I selected it. Okay. So anyhow, bonds continuing to get beat up here. Is there a flight to safety? Is this outperforming the S&P in the upward direction? No. There's no flight to safety, which continues to remain a risk-on indication for the S&P 500 itself. All right, that is that. Let's take a look through some of the sectors as ratios. And what do we see over here? This continues to look neutral to risk on the pullback. This looks okay, but it would be best if it could get back up and over that 50 SMA. Remember, if the 50 SMA is sloping up, that's okay. We ideally get back here. If the 50 SMA flattens and we're underneath with a lower high, that's where concerns would step in. We're not there yet. So bullish here, neutral. Let's come on, a little bit better. There we go. Here we go. Neutral. This is a non-issue. This is D for defensive. It's now the fourth heaviest weight sector. Do we see risk off coming into the market? No. Do we see risk off here? No. Real estate, hard assets? No. So not an issue through that. If you take a look through some other risk on and off indications here, any issues with this? No. A balance range here. If this can stay in the balance range sideways, bullish. If it can break out, even better. You're over an upward sloping 50 SMA. Over an upward sloping 50 SMA here. Over an upward sloping 50 SMA here. Looks bullish over here. Can we make the new high? That would be the determining factor. The Japanese yen carry trade is not ripping in the upward direction. There is no issue from that perspective. But speaking of hard assets like we were just a second ago, to get back onto the risk on, risk off sentiment, let's go to the gold contract first here. So we're looking at gold relative to the S&P 500. Any massive outperformance from the hard asset gold? No. There's no flight to safety happening in gold. If we take a look at, let's go back over here to the dollar now. We'll start talking about dollar and rates. I mean, breaking out of this, huge move in the upward direction, Brigade bolt out of the range. I mean, there's in theory room to continue moving in the upward direction. One of the things that I think makes sense here is if the dollar pulls back for a retest of this breakout point, right, which would be $107.50. If you get a retest of that, what's gold going to do? Gold's probably going to move in the upward direction as the dollar moves lower, right? They're roughly invert to one another. If that's the case, then what is your relative, ratio going to do? Let's come on. Where is it? There's gold. What's that going to do here? So if there's an upward pressure here for gold, right, and this stays flat, then we know that it's just purely tied to the dollar. It's not like people are rushing into gold as an inflationary hedge. So instead of trying to speculate about what this line does or does not do, you'll just use this as information when it does something to tell you if that thesis is basically true. If this remains flat, then we don't have a flight to safety. It's as simple as that, right? Let's move along to interest rates. I've gone ahead and moved the daily and the weekly here. You can see the resistance trend line that we've used to talk about the breakout in the past. And once again, with bonds looking like they could move lower, this, of course, just looks like the opposite of bull flag. I think there's easily a case to 4.7 on the 10-year, if not all the way up to 5%. So I'll maintain that stance as long as a higher low is set here over 4.5. I mean, heck, you could even get a weekly pullback to 4.3 and do this over time. I mean, the bull case for interest rates is absolutely there. And in theory, that would put pressure on the broad market. But we have not really seen that to be, the absolute truth of what's taking place, right? We've seen the broad market move higher even as interest rates have moved higher. And that's just purely based on the prospect of earnings growth into 2025, right? Markets aren't really concerned about the multiple compression. They think that earnings will be driven by actual, revenue growth, basically, earnings growth. All right, TNX covered. Let's take a look at the inverted ZT for our bonds, of course, close to the 2-year interest rate, which is going to be a proxy for the Fed tracker tool, right? If this breaks out, I know I sounded crazy last week for saying it, but if it does break out, it's an indication that the Fed might actually raise rates into 2025. I know it sounds insane to even mention, but that's one of the things we're thinking about here at the 102 handle in the inverted ZT. Speaking of the Fed tracker tool, let's just go straight to the source. Let's take a look at what's happening over here. This week, mainly on the Thursday session after the After the jobless claims, jobless claims remained okay on Thursday. We beat the expectation, and this has reverted back to only a single rate cut. At one point through the week earlier on Monday, Tuesday, we were actually pricing in the 2 rate cuts that the SEP outlines. If the labor data continues to come in strong, and this would just be the general takeaway, let's go over here so we can see it. If the labor data continues to come in strong, this upcoming week's a big week for labor. You can see this is the beat I was just talking about. If we get strong data, let's go over to this now. Thanks for bearing with me as I talk through the calendar. JOLTS, ADP non-farm, jobless claims, and then the full Monty is down here on Friday. Hourly earnings, non-farm payroll, unemployment rate, and that's, of course, the month over month. If these numbers come in strong, what does it give the Fed an opportunity to say? The Fed's going to say, hey, higher for longer. Higher for longer. You're only going to get that one single cut through 2025, and we'll just really, really keep a close eye on inflation, right? So we're in that twisted regime where good labor data might actually cause the market to go lower because it gives the Fed room to hold rates higher for longer. Something to keep tabs on, okay? So obviously we've just sort of gone through the calendar. We know that Friday is the biggest deal, but I would also say keep a sneaky eye out for this ISM Services PMI Tuesday at the 10 o'clock timeframe. Services is the sticky side of inflation. That might be one of the things that counterbalances the labor data. It's like, okay, we learned a lot about the labor market, but what are we learning about inflation? This is your sneaky little, report there on Tuesday at 10 a.m. That will be telling. FOMC meeting minutes, I don't really think that that's going to, maybe a little volatility, but not much. The bond auction at the 1 o'clock time frame is probably going to be more meaningful, right? Earnings, back into earnings season. It really kicks off on January 15th with the large banks. This week, I would say that there's not even any honorable mentions. Nothing that's going to move the market too much here. Maybe airlines, Delta. See how holiday travel went for those guys. See how they're reporting on that. But generally, that's it. Not much here on the earnings front yet. We'll wait for the January 15th timeframe, and that's all we have on the fundamental front. It's been pretty quiet the past couple of weeks, obviously with the holidays. And just a reminder, we do have that short holiday week. It's not a holiday technically, it's a Remembrance Day. Jimmy Carter, markets will be closed on Thursday this upcoming week. Let's jump into the TLT ratio to the S&P. Is there a flight to safety? As we've described earlier, the answer is no. If we take a look at the bonds relative to themselves, market's still somewhat concerned about inflation as these moves continue in the upward direction, so keep tabs on that. And this will be one of the themes that we talk about in the 2025 Outlook report. It's not done yet. We want to make sure it's nice and polished before it gets released. But taking an active approach to bonds is probably going to be a notable way to generate some sort of return here, fixed income side, for the new year. So anyway, something to think about. Let's move along to the credit spreads. I think the divergence that's happening here versus here is worth noting. The main thing that you can look at in the past is this versus this. Which one won? Obviously, you did see a move higher over time. So keeping tabs on this LQD, which is corporate grade, versus the HYG, which is just junk bonds, basically. So if this sustains this higher move, just expect volatility to remain elevated. Expect the intraday swings to remain, these wide, expansive ranges. Credit spreads, when they widen, is always an indication of volatility. So keep that in mind over here. Let's look at the HYG in isolation. It's not really as divergent as it once was. As a matter of fact, it's actually suggesting the opposite now. Crazy to think. But anyways, lows, equal lows on the S&P 500, higher lows out of the HYG junk bonds. And you can see something slightly different on the LQD. LQD is suggesting just equal lows, flat lows across the bottom. I would say that the biggest watch is just going to be if the LQD breaks down. If this breaks down here, I would just be a little bit more neutral on the S&P 500, right? If you go back to the HYG, an equal low happening down here, that just sort of adds up with everything that's already taking place. So the LQD is going to be your biggest tell from a credit perspective there. Let's jump on over to the Bitcoin. Invalidating the sell-side thesis of the red sailor shift signal on the previous weekly bars. Generally speaking, what happens on that, when you get a red signal, if you see a breach of that week's low, then you would want to start looking for some downside. Obviously, we did not breach those lows. We're back inside of this flag consolidation. I mean, let's call it for what it is, textbook bull flag. Certainly would seem like higher for now. Even if you don't want to read into it as higher, it just consolidating up here is a signal of what? More risk on than risk off, right? So risk on there out of Bitcoin. Let's take a look at, let's come on down to total breadth. Breadth is continuing to contract. New highs versus lows, yes, it's made an uptick, but it's still under the zero line, so I would still call that contractionary. You could see that the 50 SMA and 200 SMA both saw downticks, even as the market went sort of flat into the end of the week. This would be a small minor bearish data point, but not something that I would sort of go out and start shorting the market solely based on that idea. If you look at the RSP, it looks much more like the IWM. So the equal weight S&P 500 is in a bear flag here versus this trying to form a double bottom, get much closer to the top end of that balance range we've been talking about. This is a little bit of a concern. I think what this does is we get through some of these deeper data points in the video. We had a pretty bullish slant earlier in the episode when we were looking at the price levels in the S&P 500 itself, looking at internals. You know, it was pretty bullish back there. I'll admit to that. But when we look through some of the supporting evidence, I think that what it does is it just brings us that reminder that, okay, the daily has the opportunity for a lower high, right? It's technically suggesting that head and shoulders pattern. So instead of trying to be, you know, this big hero and call the bottom, just like day by day, continue to see how these levels react. And until we're back in a clean daily trend, be it up or down, doesn't matter. We'll go either way, does not matter. Until we have a clean daily trend, I think day by day is the right approach. And that's what these data points continue to sort of remind me of as we get deeper through the analysis. QQQE, similar, bearish consolidation in here, whereas this is holding up over the previous range. Not a shocker there. Shouldn't be a shocker on industrials versus transports, underneath out of transports, right? If we take a look at the volatility side of the market, it's cooling off, maybe a lower high happening here, but I would not, as we saw with credit spreads, I would not read into this and say, okay, everything's fine and dandy, market's got to go to the moon. No, we're still over 15. Still over 15 on the VIX. If we take a look at the VVIX, notice that we're under 103. Okay. Thursday's close was the last I looked at it. We were actually back above, so should have made sense given that Friday rallied that we were lower here. But regardless, not really out of the woods. I would want to see rotations back down towards 75 if things were going to like totally cool off and be in the clear for a sustained grind in the upward direction. Let's move along to volatility futures. Moving in the upward direction here, but I have to give credit where credit is due. I was watching Don Kaufman over at TheoTrade, and he brought up a great point. If we just go on over to the VIX futures here, we're technically in a decent contango on the VIX active contract, which is January. But he's right. I mean, he brought up that like this is only 35 cents of contango. This is 15 cents of contango. So the further you go out, the margin of contango just gets lower and lower and lower. I mean, right now we're sitting in a 70-cent contango. I mean, it's just not even, it's going to be very easy. Basically what I'm getting at here is it's going to be very easy for this to flip back under the zero line and cause some havoc in the market. Once again, another one of these data points that to me is just indicative of like, okay, the posture out there, it's sort of uncertain. Really, that's like bottom line here as we finish up the VIX basically is that we're sort of like uncertain as the S&P 500 is trying to navigate, yes, the head and shoulders that everybody can see, but also some of the bullish data points that we've described in today's episode. Like, can we get in here and consolidate? Can we get up here and get that counter trend to the equal high? Does the trend neutralize? Do we avoid a downtrend, right? So with these indications, the money is not made calling the very tippity top of the move. You'll get run over 9 out of 10 times doing that. The money is made once the move develops and you can take a chunk out of the middle, right? So that's sort of what I'm looking for here out of the S&P 500. Show me some resolution of this box. Show me something about this price action that gives me a definitive up or down trend, and then we'll take it from there, right? So I think leaning into the higher time frames is still the right idea. Weekly trend remains up. Monthly trend remains up. Daily trends trying to resolve this area down here day by day until we get something more clean. All right, let's jump into the core list of companies. We've got NVIDIA up first, daily time frame chart. What do we see? Nice breakout over the neckline of this as an inverted head and shoulders on the daily and even hourly. Over the 50 SMA, strong move up towards this 146.25. It, of course, is the opposite of the Man Ray pattern from back over here. We had said, and you can go back, watch the tweet video where we said, hey, if this fails, you better step out of the way immediately out of NVIDIA because there's going to be a snapback, right? So right now that's playing out. I like the inverted head and shoulders. I like the fact that we're over the neckline. That means a couple of things, either straight up continuation towards the all-time highs, or if it does pull back, holds of 140 are absolutely critical. Daily 50 SMA, stay over the neckline of the hourly inverted head and shoulders. Here it is, just so we can see it with a little bit more clarity, right? Here is your left, here's your head, here's your right. Stay over the neckline, show me an hourly high or low here, and it's bulls on parade, right? 140, ideally, I mean, if you want to split hairs, 140, 150, previous pivot top from right over here, that would be the better level to hold. That would be even more bullish, okay? So those are the levels. I would have to change my tone to neutral if this fails back down into this zone here. If we're under 140, under the gap close 139, neutral, all bets are off, looking for more clarity. And I think that ties in nicely with the theme of the S&P 500. Next up, Microsoft. What do we see out of Softy? Big failure of the range breakout. Breakout here, ideal high or low would have been there. Next best high or low would have been here. Obviously, we're just in the midpoint here. So really lackluster out of Softy. I don't love it for, any particular trades to really start unfolding. Maybe hourly inverted head and shoulders starts to emerge. Where's the neckline? Maybe it's a trend line. You guys know me at the Trade Brigade. We really prefer horizontal levels. So I think it leaves a lot to be desired, to be honest with you. It would have to pull back and show me a no-brainer risk-reward long like this if I was going to get involved. Or if it rallies and rejects in here, I'm more than happy to take Microsoft back short in the downward direction, setting some sort of daily lower high. That would look like this, right? Daily lower high underneath this level here, trading back down to the downside. So either way out of Microsoft, but it doesn't really have a compelling daily chart. So we'll move along to Apple. Apple is still not a short. Everybody was sort of like, you said it was not a short. I mean, I still don't think it's really a short. I think that Apple is still one of the relative strength monsters in the market. If it can hold up over this big weekly level, I mean, that's easily a no-brainer long situation, at least worth the attempt, in my view. If it does start to materialize off of this little bear flag as a squeeze to the upside, I think you could even get something that looks like this. First higher low here, and then starting to get active on longs over 245.75. Trades back through the thin structure retracement from Thursday. So my take on Apple is that, if you're panicking on this move, then you're basically long from the highest high in the trend count. You're not long from the breakout down here, which was a very, like, everybody and their brother, sister's mother, just like they can see the head and shoulders on the S&P 500, everybody could see this breakout level. So, why were you not long from here, right? Looking for that follow through. So anyways, Apple, one day at a time. I think that is still the idea is to look for a long. If you want to get fancy, if you want to get cute with it, and if you want to try scalps to the downside, yes, there's a little bit of thin structure through here that remains. That's underneath 241.25. That would be bear flag continuation, right? So here's your bear flag continuation. Probably brings you into that 236.50. Moving along, Amazon, what's going on with Nancy? Continues to hold the bottom end of this 220 range, this area right here. So the next step is just to Brigade bolt over 225.25. Very simple. Very, very simple chart here out of Amazon. Really lackluster daily bar. Didn't really do much. Just kind of an inside bar in the upper third. So, bull flag on the daily time frame chart. It's hard to be a bear here out of Amazon. I would like to see the Brigade bolt over 225.25 to get into the all-time high 230.250. Even if it breaks down, I wouldn't be a bear here. I would be a bull looking for a higher low at 214. We are in an overall uptrend, right? Next up, we've got Google. Google. Getting pretty compressed in the overall range here, looking for that to resolve. It really has not been clean around 190.75. Here it is on the hourly time frame chart. Notice that we overshot. There was no gap fill reversal. We sort of chopped straight through it on the Thursday open, Friday tested, and then rallied into the close. Weird stuff. So 190.75 might need to be rethought as a level. I don't see this with that much clarity as of right now. So if you see it better, then kudos to you. But to me, it's really just like doing this, and until we get either this or until we get something that's even this becomes pretty difficult, noting what happened on Thursday, right? So need more clarity out of Google. I don't think the daily chart is setting up cleanly. Metaverse, on the other hand, is more similar to Amazon. It has much more of a clean structure to be dealing with. This is the New Balance range, not sponsored by New Balance. Wish we were. But over 607.75, Brigade bolts back up towards the top of this prior range. If we just chop around in this range, it's neutral until proven otherwise, and a loss of the daily 50 SMA probably brings us back down towards these lows at 561. So a very straightforward chart here out of the Metaverse. Nothing to really, read into too much. I would say that holds over 599. We've inverted these levels. We used to have 588.25 dim, 599 firm. We've inverted that just based on the way that this range has developed, right? So midpoint is really now this gets bullish. If we're just chopping around in here, nothing to do. And this is where the bears step up, right? Under 588.25. So preference here. Absolutely here. That would be what I would like to trade for, and of course that would help the S&P 500 higher. Tesla, the one stock to not rule them all, but definitely capturing everybody's attention with those delivery numbers on the gap down from Thursday. I mean, it didn't even give anybody a chance. Didn't give anybody a chance at 358.50. That was the best watch, or it still is a really, really strong watch, but as of right now, not making it all the way to that level. I will say that the double top is in force for a retest of the neckline, obviously on the counter trend move here. If this sets a lower high and rotates to the downside, that would be another opportunity to possibly get this style move back in the upward direction over time. Now, this is not this is not a scalp. This is not a 1 or 2 day trade. This is something that could take some time. So just be mindful of that. It's a very strong level from the daily time frame chart, but you should not be expecting that 2 days go by and you're back at the all-time high, right? So lower high under the neckline here gets you to that retest entry level, then looking for the upswing over time. If this blasts over 415 and sets a higher low, I would want to be long here for the same outcome. Back to the all-time high 488.54. Okay? That is your Tesla chart. Anything under this zone right here, under 358.50, probably talking about a move back down, at least to this. I would really start thinking about the deep pullback low at 310. 310, let's go 50. You guys know me. Round numbers only up here in the penthouse, and this one should be 50 as well. All right, so there we have it. And let's go. Oops, we want 50, and we want a dim dashed level. There we go. Beautiful. Okay, that is that. Why did that not take the proper gray? Let's take the proper gray. There we go. All right, so that is your Tesla roadmap with some updated downside levels. If there is no hold of 350, 850, keep doing that. If there's no hold there, then we'll change our tone. Okay, hourly time frame chart, anything to learn from this perspective? Obviously, if this sets a higher low here, now you have a higher low double bottom. Where's your neckline? It's at the 415. This is where we change our tone there. So this persists with the bullish nature. So first thought is risk reward back down to the low, right, to keep the rejection off of the neckline here. If it pulls back, so again, your target has to be reasonable here. There's a 3-to-1, 2-to-1 intraday, whatever. Trim some here. If it starts to reverse off of it, then you would want to, bail on the short side, obviously, and then wait for this back on the long side over that neckline. If it just goes straight through, you'll balloon your runners into the low, if not possibly all the way into 350, 850. Let's move along to JP Morgan. Not much to really talk about here. It's not a great trader, but we keep tabs on it for the XLF. Remember, look below and fail is the name of the game. Ideally, a rotation to 248 is bullish for the S&P 500. Netflix is doing what? Netflix is I think Netflix, maybe like Google, is kind of unclear. It's definitely a bit more bearish underneath this 907.25, but look at the hourly time frame chart here. These levels were chopped around quite a bit before finally on that Friday session, not to mention that it tried to rally first before rejecting. 894, as long as we're underneath that, it keeps the bearish pressure on, a lot of overhead supply. You've got a lower high that's developed into the afternoon, a little H pattern on Friday. So through the equal lows, I think you're just looking for continuation, but you just have to be mindful of your risk reward at this point. If you can pick off the 2-to-1, then great, but if you can't into 868, no reason to take that trade. So one step at a time out of Netflix. AMD, the advanced money destroyer, trying to change tone on the daily time frame chart, trying to look for that double bottom here. The neckline is at 127.15, which is also the neckline of what was the inverted head and shoulders. Now, obviously, the right shoulder did not persist. Some might make the argument that, it's a really sloppy one like this. I don't really subscribe to that type of idea, but for now, I would consider that this is a double bottom. We're over that. If we could stay over 122.20, it keeps this in play, and this is the daily double bottom neckline, 127.15. So still watching AMD. We've had mixed feelings about it on the core list of companies for quite some time now, but I feel like it deserves a spot for this weekend's analysis. 122.20, if it holds, sets up this, and then if we can ultimately get this over time, we have the bullish daily change in tone over 127.15. Singular trade idea, and then you're on your way for this weekend. What do we have? It's CRM. Salesforce. What's going on with Salesforce? I like the daily pullback. I like the 50 SMA. I like the inside hammer from Friday. You've had a very controlled pullback from the highs. It's not like this went straight down like we've seen some other things do. Remember CrowdStrike when it was, sort of had its horrible news. Let's just go there for a second. CRWD. It's not like the pullback looked like this. That's for darn sure. So it's been a much more mild pullback out of CRM. Reasonable pullback. Some might argue that just like the S&P, maybe you have a little bit of head and shoulders setting up happening like this. But my first thought is just that the market looked underneath this prior low on the breakdown from Thursday, but yet closed back above on Friday. We've supported off of the daily 50 SMA. The overwhelming trend here is up since June on the gap down from earnings back over here. So the trend is bullish. The sellers are not really accelerating underneath this low. This is a pullback from the highest high in the trend count. Hourly time frame chart starts to show us if we can hold up over 332, this might even turn into a little bit of an inverted head and shoulders. Back up towards the top of the range would be the target, 345. So risk reward is the name of the game and what we'll be scouting for early on in the coming weeks worth of trade. And with that, we are done with this weekend's episode of the weekly watch list. There we go. Yes, the weekly watch list. So if you enjoyed the episode or learned anything new, let me know down below in the comment section or by giving the video a very simple thumbs up. Just as a reminder, we will be live at 8 o'clock Eastern time on Monday, as we typically are for our pre-market prep. We hope to see you there up in the penthouse for the morning brief. Have a green trading week and enjoy your weekend. I will see you in the next one.